Welcome back. Now, nearly half of South Africans aged 15 to 34 are unemployed. With this, the government is officially launching a 2.5 billion Rand Youth Fund, a long-awaited initiative aimed at supporting high-potential small businesses owned by young people. Spearheaded by the National Youth Development Agency, the fund marks a shift from micro-grants to larger equity-based and loan investments. But the question remains, will it be enough? Joining us to unpack the fund's rollouts, its goal, and what it means for young entrepreneurs across the country is Tiyani Mohlaba, Chief Operations Officer at the Afrika Tikkun Foundation. Tiyani, thanks so much for your time today. Now, we know that youth unemployment is one of South Africa's greatest threats, not just on the economy, but also affecting social stability. And I'm wondering whether NYDA's model to shift from a grant model towards a loan and equity-based model is conducive. Does this approach risk turning empowerment into indebtedness?
Thank you very much. It's a very valid point that you're raising. I think, we welcome it. It's basically long overdue because one of the challenges that we've had is that we were just okay historically to just issue funds, without monitoring whether those funds are creating sustainable businesses for these young people. So when you combine that with the loan aspect, it places a lot of responsibility on whoever gets the grant, to make sure that they use the money effectively and, most importantly, get the mentorship that is required to make their businesses successful.
So sustainable businesses really looking to benefit from this initiative. What I've been seeing over the past few years is there's been growing focus on the township economy, both private and public sector, showing interest there. Interestingly, the fund is targeting high growth sectors like energy, mining and manufacturing. But many youth entrepreneurs are in, the township or informal economy. How are we going to make sure that they aren't left behind?
You may be curious to know that we've got, a number of young people with those qualifications, degrees, in mining, in meteorology, who are not necessarily employed because, the mining sector also went through a lot of downsizing. But, from a beneficiation point of view, there's huge opportunity. And if you look at the whole, kind of retail sector, where the local businesses, and we've shared this as Afrika Tikkun before. If you look at, the entire value chain of bread production in the country, especially in the townships, Ikota is part to represent another value chain that from basically producing flour to make that bread. Smaller garages, young people starting garages where they can have small mills that they produce the flour, send it to someone who makes the bread and bakes the bread, send it, and also from a social cohesion point of view, and I think it's important that we underscore this. We currently have spaza shops in the townships, predominantly, run by our brothers from up north, our Somali brothers, Pakistanis, who basically, I think, would be more than willing and open to say, look, if you supply us with quality bread, we are prepared to take it and sell it, to the community. Because what that does, it also creates that social cohesion. Instead of just driving them out, we are saying, look, you are welcome, but also what we want is to partner with you to make sure that the bread that you sell there, to make kotas, patlu, and whatever, is basically produced locally in the township, and you're supporting youth businesses that are producing not just bread, all other aspects of food, that the young people could be willing to produce and sell to the communities.
So basically improving supply chains within the township economy. Now, Afrika Tikkun has long worked to bridge the gap between training and employment. Just walk me through some of the lessons you've learned about why training alone doesn't always lead to jobs.
Right. So you would understand that most of our young people, when they are asked, in interviews, we see your CV, you're good, you qualified in ABC, what experience do you have? You know, and therein lies the challenge. Hence, Afrika Tikkun's model is that of, you know, coming with work readiness programs to help young people who have been sitting with qualifications, unemployed, who've never been to any, you know, employment environment, to teach them how to basically have that work ethic and be ready to start, you know, in an employment situation. But also, our model is such that we go to industry and say, in the next 3 to 5 years, what skills will you be employing for? Help us train and prepare young people for those kind of skills. In ICT, in hospitality. Now we are also seeing that there's a lot of outsource from a business process outsourcing point of view, where call centers want basically to set up business in South Africa. And those are some of the opportunities that we train young people in terms of how to be the greatest call center agent in the world and communicate with customers from diverse and different backgrounds.
And, you know, we always point to economic growth being, you know, the one thing that can solve the crisis. But we also need to look at what we can do under these circumstances, really coordination from all stakeholders, that being government, NGOs, as well as the private sector. Tiyani, unfortunately, we have to leave it there. Thanks so much for your time and insights today. That was Tiyani Mohlaba, Chief Operations Officer at Afrika Tikkun Foundation. Now, shifting focus, Africa's economic landscape is being reshaped by political transitions, policy shifts, and the redirection of global capital flows. RMB has released its latest Where to Invest in Africa report, spotlighting how African nations are shifting from dependency toward resilience and self-determination, with a renewed focus on sustainable growth, regional collaboration and private sector participation. Earlier today, I spoke with Samantha Singh Jami, Head of Africa Research and Strategy at RMB. We kicked off the interview by exploring how the changes to the index's methodology have affected the rankings and what those changes reveal about shifting investment trends across Africa. Here's what she had to say.
I think on the Where to Invest, obviously it's the second edition with a relatively new methodology. So the global impact and the uncertainty that we've seen last year did play a role in this year's rankings to some extent. So let me just break it down. I think there's two parts to it. The methodology in itself is the same. We tried to do something very robust last year when we looked at how to develop the Where to Invest in Africa rankings. So it's still your 4 pillars and your 20-odd indicators. So okay. That remains the same. But where we are starting to see more themes evolve is around the aid and trade, as you said. So we've got a few things in the document that highlight export potential, showing that, South Africa has about $75 billion of exports that they could potentially do. Obviously, we can unpack at some point how these get done. And the other thing is the shift from aid to investment. And we saw that last year it was a massive year for sub-Saharan Africa, or broader Africa, the entire continent in terms of FDI flows. So there was about 97 billion coming through onto the continent. Granted that about 35 billion of that went to Egypt because of the Ras Al Hekma development. So yeah, we do unpack a little bit on the trade and investment leg that we are starting to see unfold.
And have you seen any difference when it comes to investment flows as we look at the broader macroeconomic picture, as well as this wave of protectionism that has hit the world as well?
I think the investment flows are also in two parts. There's your FDI investments, and when we look at it, some of the recipient countries or the large recipient countries are still the same. And I mentioned that there has been a super year for FDI. Granted, a lot of it was Egypt, but South Africa, Morocco, Egypt, Tunisia are some of the larger recipients of FDI, and that still stands. But I think where we're starting to see a little bit more of a change is, in the type of investments that are being made. Obviously, in some parts of the continent, there's still some energy issues, and you're starting to see a lot of focus in renewables. So you're starting to see that come through, especially in Southern Africa, where we've had lots of, a drought due to El Nino. So from that investment landscape, I think, it's still pretty robust. From, a portfolio investor type of landscape, I mean, the domestic conditions, like your currency, the volatility around that, your interest rate cycle has played a role. And I think when you look at it from a liquidity perspective or international liquidity perspective, you do see that there is still a lot of appetite for investments to Africa in that respect.
And quickly before I let you go then, Samantha, it's been interesting that you say that the bigger economies like your Egypt and SA are larger recipients of FDI. But when you look at rankings, it's the smaller countries that are faring well. Maybe just take us through what's giving the likes of a Seychelles or a Mauritius the edge.
Yeah, so I think, when we looked at making changing the methodology. I mean, the purpose was, the ultimate rank is quite theoretical, and individuals definitely need to assess the index components holistically. So it also depends what you want to invest in. I think where the smaller countries or the islands, basically Seychelles and Mauritius, rank first and second for a second year, it's largely to do with less corruption.
Okay.
There's a lot of innovation that goes on in these markets. From an economy structure side, it's maybe a little bit better to some extent. Obviously, the size of the economies are very small, but I think in terms of diversification, innovation, relatively high levels of growth, it's still pretty good. So those factors do influence the overall rating for these countries.
That was Samantha Singh Jami, Head of Africa Research and Strategy at RMB.